Good afternoon. Welcome to today's Alpha Beta Series webinar, Emerging Markets, Looking Back and Looking Ahead. This is the latest installment in our asset class focused Alpha Beta webinar series. My name is Dave Nadig, and I'm the Director of Research here at IndexUniverse. I'm very excited today to be joined by Luciano Siracusano, the Chief Investment Strategist at WisdomTree Asset Management, to talk about this topic. Luch is one of the smartest guys I know on emerging markets and currency and a number of other topics, so I'm excited to have a conversation with him and share that with you when we talk about investing in emerging markets and some of the challenges we're going to face. The format for the webinar today is quite simple. For the first 30 minutes or so, I'm going to cover some of the arguments for investing in emerging markets and take a deep dive into the various ETFs you can use to express an opinion about which way they might be headed. We'll be looking at everything from correlations to expense ratios to tracking error, so we're going to cover a lot of ground. Then I want to bring in Luch and talk to him about different ways of approaching the emerging markets and maybe give us some context and talk about some of the potential opportunities and pitfalls specifically for ETF investors. Then we'll have 20 minutes or so of Q&A with the audience where you can ask questions of us. I anticipate it'll be pretty lively. As a participant in this webinar, you're invited to ask questions using the Q&A tool at the bottom right-hand part of your webinar browser. Please don't wait till the very end to ask your questions. Ask them throughout the webinar as they occur to you. We'll collate those questions and we'll answer as many as we can during the Q&A session at the end. One thing I'm going to answer right up front, we always get asked by participants every time two things. Really, one is whether or not you can get access to the slides. A recorded version of this webinar and the slides will be available at the IndexUniverse.com website within a few days of the end of this webinar. The second question we always get asked is, what about CE credits? If you're CE credit eligible, you'll be receiving separate emails with that information. With that, let's go ahead and get started. So let's start off with the first big question right off the bat. What's the point of emerging markets investing? Like, what's all the fuss about? And really, it's about this. Over the past decade, emerging markets has really been where a lot of the performance has been. This is looking at the MSCI Emerging Markets Index over the last 10 years. That's the most popular broad emerging markets index. And if you'd invested in that 10 years ago, you're up over 200% today versus about 50% if you've been in the S&P 500. And of course, it doesn't take a genius to look at these lines and realize that timing has mattered a lot here. At least it's mattered as much as having a long time horizon. I sure wouldn't have wanted my whole portfolio sitting in the emerging markets, say, going into 2008 and then riding that all the way down into 2009. But boy, I wouldn't have minded starting in 2009 and picking that up on the other side. So how do you think about how this fits in your overall portfolio? Well, really, like any investment, you have to consider the value of emerging markets, of any one emerging markets investment, not in a vacuum. But you have to think about it in terms of correlation and how it's going to impact the rest of your portfolio. The whole idea of investing in some other asset than, say, just the S&P 500 is that you believe that it will not just perform better, but that it will perform differently, that it's going to zig when the market zags. And if you were an investor looking at daily correlation of returns, which is how a lot of people often look at this, between, say, the S&P 500 and that MSCI Developed International Index, or EFA, and emerging markets, it would look pretty good in 2003, with emerging markets just 64% correlated to the U.S. But look at what's happened in the last year. Correlation's up in the 90s in 2011. That doesn't seem like a lot of diversification. So what's going on here? Well, the first thing we need to remember is that correlations for everything have gone up. You hear the press talking about risk-on, risk-off trades, and some of that's true. One reason that emerging markets are so much more likely to go up when the S&P goes up now is that large traders are, in fact, moving money in and out of both at the same time based on large global macroeconomic factors or potential shocks in the market. But the other thing to remember about correlations is that they're complex and that they're layered. This looks at the weekly correlations, perhaps a more useful time opinion than just looking at what happens on one day, between the S&P 500 and a broad swath of individual emerging markets countries with the broad index at the top. And you can see there's a huge difference between being in, say, Malaysia, which is very uncorrelated to the U.S., and someplace like Mexico, which is extremely correlated to the U.S. On the face of it, that makes a lot of sense. Mexico, Brazil, or Chile, the most correlated countries, They're closer to the U.S. They're big trading partners. There's a lot in common with what goes on with U.S. business. Malaysia, of course, is all the way across the globe and comparatively small. And this is just the first of many slides where I'm going to talk about why index selection can be so important when you're thinking about emerging markets. So the other thing that we take into account here is timing and time horizon. It makes a huge difference when you're trying to pick an uncorrelated assets. Now, most investors I know aren't thinking about emerging markets as a trade. They're thinking about it not for a day or a week, but more like a few months, almost a seasonal decision. So for the rest of this presentation, I'm going to really mostly look at 40-day types of correlations, 40 trading day correlations. Now, this first big fat line at the top is just the correlation between that broad emerging markets index and the S&P 500, and it's bounced around between 1, which is almost perfectly correlated, and about 75, which is at least enough to think about diversification benefits. So why all the bouncing? Well, if you remember the fall of 2011 like I do, it's when we had huge VIX spikes, right? Volatility went crazy. And during that craziness, unfortunately for most investors, correlations of everything skyrocketed. Volatility rolled through virtually all asset classes at the same time. When things calmed down a bit this spring, when the line starts fading back, you can see the correlations again plummeted. They came back down towards the 70s. And as an investor, these kinds of shifting sands in correlation can make it quite difficult to figure out how diverse your diversification actually is. Of course, one way to think about getting more uncorrelation, a better diversification benefit, is to think about buying individual countries instead of big baskets. This is the same data, but we have the largest emerging market countries underneath it. And if you could tease out the top line, the one that's the most correlated, you'd notice that that's South Korea, and we'll get to that in a minute. If you dig deeper into the emerging markets, into the smaller and smaller countries, you start to find out there's some actually very uncorrelated countries in here. You can see, for instance, in November of 2010, Chile was only 30% correlated to the U.S. That was a good thing then. Chile had a nice little rally while the S&P was essentially flat. So that was a good thing. Of course, the next low correlation period, the second little bubble I've circled there, the exact opposite happened. Chile gave back most of that gain. Simultaneously, the S&P rallied 10%. So low correlation doesn't always mean something's going to go up by any means. It just means you're going to get these periods of one thing going one way and another going in a different direction. So what's the point? The point is, if non-correlation is your goal, you may have to dig a little deeper into more niche products than some of the broader-based products that are more common in the market. So for the rest of this presentation, I want to talk about 3 core ways that ETF investors can look for different kinds of exposure to the emerging markets and how you should think about those decisions. We're going to look at the challenges of getting good equity exposure, as these first charts have already hinted. We're going to look at emerging markets bonds and talk about what's behind some of the huge growth we've seen there, and certainly the investor interest we've seen there. And last, we're going to look at currency impact, both in terms of how it impacts the fixed income and equity, but also as an asset class to itself. So let's dig into our first section, which is really the equity component. Now, when we look at equities, there's some always issues that are always going to affect you as an emerging market investor. The first one is, what kind of index am I tracking? This really matters quite a bit. What countries am I gaining exposure to? How am I weighting between those countries? As we just saw, having exposure to the right country really makes a difference between diversification and non-diversification. And last, sector exposure. Diversifying by sector can have a huge effect on how your fund performs in relation to a different fund. And knowing that exposure can help you better select the right product for you. So the first big question when you're thinking about things, in my opinion, is size. Many people just immediately leap to something like EEM or VWO, which are the 2 large MSCI emerging markets products, but there are real issues with that approach. And one of the biggest one is that they're purely cap weighted across all of the stocks in the emerging markets. Now, one little dirty little secret of indexing is that nobody really knows exactly what a large cap stock is, or a mid cap stock, or a small cap, right? So when the S&P expanded to 500 stocks in 1957, there were only 1,000 stocks, and so that was half the market. But now there are 5,000 stocks. So is that still the same large cap benchmark it was before, since now it's only 10% of the market? And obviously, those kinds of decisions get even more complicated when you head overseas. So take a company like this, Empresas Copec. It's a huge Chilean mining company. It's the single largest company in the domestic Chilean stock market. It's the mega cap. However, inside the MSCI Emerging Markets Index, it's just the 255th largest company. So if you're building a global index, where do you put Impressus as part of that, right? It's one of the largest companies in Chile. So does that make it a large cap, or is it a mid cap because it's in the middle of the emerging markets, or is it a small cap because compared to global market cap against companies like Apple and Microsoft, it's actually tiny? We would suggest that doing these things by some kind of percentage of market cap rather than by some naive security count makes sense at the face of it. But really, it's much more important to be thinking about what you're actually trying to get exposure to. I mean, you may be investing in emerging markets thinking you're getting exposure to companies like this, but in fact, with something like EEM, your exposure is so small to a relative Chilean giant like this, it might as well not exist. And this really just highlights the incredible importance of country classification. The line between a developed market and an emerging market, and sometimes even a frontier market, really varies between different index providers and different funds that are tracking those indexes. So each of the big three players, MSCI and FTSE and S&P, they all have their own criteria for deciding whether a country is emerging or developed or frontier. And when push comes to shove, it often ends up just being about South Korea. MSCI still considers this an emerging market, which means that they get a huge allocation inside any cap-weighted MSCI-based product. The other two approaches, the FTSE and the S&P, think of them as being a major developed rules-based economy with free-flowing capital, and they stick it in their industrialized baskets. And if you look at the difference between funds tracking those indexes, you can see it quite clearly here. EEM has a 15% weight in South Korea. That's obviously going to have a huge impact compared to the 0 weight you're getting out of, say, SCHE or GMM. It really does make a difference. Which brings us to sort of a last point here, which is about weighting, right? So does your fund have a 90% weight in BRIC countries? Probably. I'm sure we're going to talk to Luch more about this, but the cap weighting schemes make a huge difference in terms of how you're going to be allocated. You look at something like a dividend weighted index here or a small cap index, much more heavily weighted in some place like Taiwan, which is dominated by smaller, profitable companies than, say, the larger cap companies that might not be paying dividends, but represent a larger portion of something like, say, South Korea, or even someplace like Brazil. It also makes a huge difference in terms of the kinds of tilts you're taking. And really, I think sector is probably an underrated piece of importance in emerging markets investing. Cap weighting, or that size bias, really does impact what kind of sector bets you're taking. Many investors look to the emerging markets because they think they're placing a bet on probably one of two things. They either think they're making an emerging markets infrastructure bet, in which case they want to be in things like utilities and phone companies and the stuff that's going to make these countries enter, the next generation of industrialized nations, or they think they're betting on the emerging consumer. They think they're betting on sort of new wealth coming into the hands of people. Unfortunately, traditional cap weighting doesn't actually capture either one of those sectors particularly well. So here we're looking at EEM on the left and a dividend-weighted approach in the middle and a small cap-weighted approach on the right. And as you can see, the dividend-weighted approach really does capture that sort of infrastructure type play. You've got a large allocation to utilities and telecom companies, right? That's the play that you're making there. On the other hand, the small cap sector really loads you up into that consumer segment, right? So this kind of decision, which on the surface looks like a weighting distinction, is actually giving you a very significant sector bet at the same time. So then the question is, how much is that going to affect you, right? The answer, of course, is plenty. In this chart, DEM comes out on top for this period, but obviously in any given period you could get different results. The point here isn't the absolute returns, it's that in this case, this difference in approach over a 3-year period was a 25% difference in your total returns. That's obviously a very substantial portion of the returns that are available in the market. And of course, you've got way more choices than just those 3 funds. If you want broad, non-regional, non-country exposure, you've got about 52 funds to choose from. In that, 21 of those are ostensibly trying to give you some kind of access to that total market. But you can also slice that broad market by sectors or cap range or yield or even actively managed strategies. And if you have an opinion about specific geographies, whether that's China, or Asia Pacific or emerging Europe, you still got tons of options with another 96 funds. In fact, roughly 10% of all ETFs in existence are tracking the emerging market equity space in one way or another. It's been one of the biggest areas of growth. Let's just dig into one narrow slice there for a second, though, to really walk through what this ETF selection process looks like. These are 4 popular China ETFs to start with, and they're all perfectly valid plays on China, but they're accessing the market in fundamentally different ways. You take something like FXI, which is sort of the name brand player in the space. It's actually only investing in the 25 very largest companies in Hong Kong, most of which were ex-state-owned Chinese businesses. And if you're going after China because you think you're going to capture this growth engine, investing in FXI is a little bit like saying you're going to capture the American entrepreneurial spirit just by investing in Ford and Microsoft. Unless you're deliberately looking at that narrow slice of China, a smaller find like, say, GXC is probably a better choice to invest in a broader slice of the market that includes not just Hong Kong stocks, but also companies that listed here in the U.S. or are listed here through ADRs. Or you could just invest in those ADRs with something like PGJ, or you could go with something like PEK, a new fund from Van Eck, which invests in the effectively impossible to find Chinese A-share market using swaps. There are 4 extremely different approaches to the simple thesis of, hey, I want to be in China. And if you look at the total return since PEC was launched a few years ago, as you would expect, they've had very different results. A 9% spread in returns over just a little over 2 years. And if we back out to 3 years, there's a whopping 15% difference between GXI and FXI, GXC and FXI, 2 funds ostensibly trying to track the exact same market. Now, there's no guarantee this is going to play this way in the future, right? Obviously, there are things that were benefiting GXC and its smaller cap play than were affecting FXI. Those things could reverse. The point here is you need to think beyond just, I want to make an allocation to China, and towards what kind of allocation to China do you want to make. So I wanted to also hit on fixed income briefly before we bring Lucian to sort of continue the conversation. So let's start with fixed income, and then we'll hit some of the currency effects. Fixed income has had a slow but steady progress. We've seen a lot of fund launches over the last few years. And a lot of those products have come out just recently, which can make them slightly difficult to analyze. So I thought it was worth doing a little bit of digging. There aren't a ton of choices in the space, but the choices you can make are quite real. The big distinction really comes down to whether or not you're investing in U.S. dollar-denominated fixed income products that happen to be issued by foreign countries, by emerging markets countries, or whether you're looking at the local bonds that are being issued in the local currency. The difference here really has made, the choice really has made a difference to investors. Let's start by thinking about sovereign debt. Now, with everything that's been blowing up in Greece and Europe, a lot of people have been looking to nations that may, on the surface, seem less risky, or seem more risky than, say, Greece or Spain or Italy, but may, in fact, offer a better return for your credit dollar. Right? Here we see broad U.S. treasuries yielding an average of about 82 basis points, which is effectively nothing. You see the international space yielding more like 2%, and then you look at emerging market U.S. dollar bonds, and it's over 4.5. That seems like just a fantastic deal, especially when you consider it's a BB minus rating, which frankly is not that bad considering the yields you get out of similar rated company here in the U.S. So what's really happening here? Well, if you look at the broad set of options that you have, you can really put them into 2 buckets, right? And the top bucket here, since last year, is those bonds that have been issued on the U.S. dollar. The bottom market here, the bottom 2 lines here, are sovereign bonds that have been issued in their local currency. So you can see that there's a currency effect here, which we'll get back to. Although within those categories of U.S. dollar and local, you've seen quite similar performance between different approaches. They are, after all, buying essentially the same sets of bonds issued by the same countries. The good news, though, is that while the yields may not be crazy high, the correlation benefits are really quite significant. In this chart, we're looking at 2 of these approaches, EMB and EBND, the top one being a U.S. dollar version of sovereign debt, the bottom one being a local version of that. And as you would expect, the local currency version is even less correlated to the dollar than EMB is, and both of them are correlated extremely low to the equivalent treasury investment here in the U.S. So while the correlations may be rising substantially on the equity side of the shop, here in the fixed income part of the market, you can still get this huge correlation benefit versus a traditional treasury portfolio of government debt. And there are now some, although not as many as we'd like, emerging market corporate products out on the market as well. This is looking at one of those, ECMB, and it's comparable here in the U.S., which was LQD. And really, this is about the best you can hope for when you're looking for a non-correlated asset, right? There's very little connection between bonds from companies in, say, Chile or Argentina or Brazil and the bonds from companies here in the U.S. They're just simply performing in different worlds. Now let's take a look at the last major impact here, which is currency. Now whether you've ever considered investing directly in currencies or not, it is going to have a huge impact on any international investment. So let's think through what that means for a second. Let's just start with equities. So what's the difference between that stellar equity return chart I put up at the beginning with and without currency? The answer is somewhat surprising. This looks at the MSCI Emerging Markets Index in red, which we've looked at a couple times already, and then a hedged version of that, which effectively removes the impact of any currency. Now, the answer here is somewhat surprising. You actually end up with nearly the same performance over this particular time period, 10 years, but with lower volatility. The spikes simply aren't as high on the upside, the drops aren't as deep on the downside, and intuitively this should make sense. If you believe that currency in the long run is a bit of a zero-sum game, then ultimately the actual growth of the economies and companies should be what determines the performance of this index, not foreign exchange. So the foreign exchange here is effectively amplifying the volatility of the underlying. You see this impact elsewhere too. This is that same chart we just looked at in fixed income with the MSCI Emerging Market Currency Index just overlaid across it. And you can see it's nearly a perfect match, right? The local bond investment has almost served as a proxy for the same exposure if you were just investing in the emerging market currency, right? All the difference here is in this currency. It's a pretty unmistakable conclusion. Now, of course, you can actually just directly invest in that pattern of returns. In this case, we have two funds providing different kind of exposure here. The bottom line is the WisdomTree Dreyfus Emerging Currency Fund, which is a bit of a cash-like vehicle, with full currency exposure, so it's cash plus a little bit of yield. The top line is ELD, which is a longer duration fixed income fund with similar kinds of currency exposure. And as you can see, just adding a little bit of duration exposure helps make this less of just a pure currency play and get you a little bit ahead of the game. So one way to think about investing in these types of currencies is, do you want to be investing effectively in a bank deposit, right, and you getting that small amount of yield, or are you willing to step a little bit further out on the curve and invest in something a little bit more like a short-term bond fund than, say, a certificate of deposit? Now, one of the key things here is that when you make these kinds of currency plays, whether it's in emerging markets or in just any international foreign currency, understanding how the fund gets its exposure, how it's structured, and what its tax implications are going to matter a tremendous amount to your actual performance. It's actually one of the trickiest areas of the ETF market, so it's worth taking a little bit of a look at it. This really is sort of the deep end of the pool in terms of structure and taxation. At their simplest, the sort of widely used funds like, say, the currency shares products, they quite literally just take your cash and they stick it in a foreign bank account. And everything then just gets taxed at short-term rates. No matter how long you hold it, it's just income. And that's just how currency works, and it's frankly not a particularly great tax treatment for most investors. All the way on the other side, you have the WisdomTree products, which invest mostly in forwards and swaps, which at least get traditional long-term equity appreciation taxation, so you can at least get long-term tax treatment on your gains. All the way on the right side of the page, you've got some futures-based products, particularly the popular UDN and UUP funds, and a handful of currency ETNs, which possibly have the worst tax treatment in investing. Not only do you have to pay your short-term tax rate on everything, you actually have to pay your short-term tax rate on undistributed notional yield in the ETN. So you may not get a dime from it, but you still have to pay taxes on it. For most investors, unless you're going after a very specific strategy, you're probably going to want to be on the left-hand side of this page, not on the right-hand side of the page. And last, I thought it would be worth at least mentioning China in this context, as I think a lot of folks still get confused about the Chinese renminbi. There's still no direct way to get that Chinese currency exposure, although I get plenty of emails from people asking me how they can. Both VanEck and WisdomTree have funds which use the forwards markets to at least provide some exposure here. CYB is actively managed. That's the WisdomTree product. CNY, the VanEck product, just rolls into 3-month forwards contracts. And this is one case where I'm willing to say that that human element, or at least that flexibility, seems to have paid off. While neither fund has managed to match the unbuyable currency, which is that top spot line, CYB has definitely done a better job here, and it's done so for about 10 basis points less than its competition. So the point here is simply to say, once again, you need to make sure you understand what you're after. You may think you're buying Chinese spot currency rates. Nobody is actually buying Chinese spot currency rates. You're doing the best you can in these types of products, however. And last, I wanted to just hit a couple quick sort of risks and pitfalls before we bring in Luch here. If those last few charts were a little confusing, that's a bit intentional. Investing in the emerging markets does require paying a little bit more attention than it does than just, say, remembering the ticker of your favorite U.S. domestic ETF. So I want to leave you with a few thoughts about what to look at, some things that might trip you up when you begin your own due diligence process looking for specific ETFs. The first thing that really needs to be said is that you just need to expect that you're going to pay a little bit more for emerging markets exposure. While we're generally of the opinion that, costs should be as low as possible, and certainly that's how I try to manage my own portfolio, it's simply true that it does actually take more human work to run a fund that invests in a less developed country. It takes people to manage custodial relationships, to deal with pricing, frankly, to clean data, to manage corporate actions, which may be less conveniently obvious than they are here in the U.S., and so on. So all of these funds are generally pricier than their developed or U.S. counterparts, and you should just expect that going in. By no means should you be throwing caution to the wind and investing in funds that have 1.5% expense ratios willy-nilly. You should still be a cost-conscious consumer, but you should expect that you're going to end up paying a little bit more. The other thing to keep in mind is that perfect tracking error, the kind of perfect tracking error people have come to expect from funds like SPY and GLD, really just doesn't happen when you're out this far in the emerging markets. These are all simply more difficult indexes to manage against, and they're real-world problems of execution and investability and optimization, sometimes even capital controls that can make it quite difficult and challenging to manage these indexes. This chart looks at the rolling one-year tracking difference, so the sort of difference between what you would get as an investor in a year versus what the index would say you should get in a year over one-year periods rolling back for a year. And it's looking at two different BRIC funds, the Brazil, Russia, India, China funds. The fund on the top, EEB, which looks like it's tracking both better and more consistently, is just investing in ADRs, and it's only investing in about 80 of them. So effectively, it's being managed like a U.S. product because it's just buying things that are available, with few exceptions, on the New York Stock Exchange. So this looks like it's trading great. Now, BKF, the one on the bottom, tracks an index of hundreds of local shares in those 4 markets, and it should be obvious that this one's going to simply be harder to manage. It's going to be harder to track. Honestly, we consider the tracking error of BKF, in this case, not all that bad given what it's trying to do. And EEB, while it may look great on the tracking side, may not actually be all that representative of the true BRIC market you're hoping to get access to. You're getting just that ADR part of the market. Even when you're tracking the same index, however, it can actually be quite hard to tell the differences here. This looks at 2 different ETFs tracking the exact same MSCI Emerging Markets Index. It's the 2 biggest funds in the space, EEM and VWO. EEM from iShares, VWO from Vanguard. The reality here is not what you would think it is. VWO, the Vanguard fund, looks like it's doing a terrible job, but in fact what it's doing is using different accounting than the rest of the industry. Instead of simply looking to price its portfolio the way the index does, it actually reprices all the securities it holds at 4 p.m. Eastern when the New York market closes, and uses a formula to assign a fair value to that portfolio. Now that may sound like a great idea, but it makes trying to do any kind of tracking error analysis on a fund like this effectively impossible. The point here is simply to say, don't always believe what you read when you're looking at things like premiums and discounts and net asset values, et cetera. Because sometimes, like in the case of a few funds, and these will be my last two slides before we bring Lucian, you do get legitimate discrepancies between what you're paying for a fund and what it's actually worth. You take a market like Vietnam, this is the fund from Van Eck that's tracking that, it's had continuous problems trying to get close tracking to its underlying index because Vietnam has been wrestling with capital controls and becoming a true free market economy. There have been these moments where it's simply difficult for authorized participants to effectively either get the securities they need or to hedge this fund. And when that happens, you see it trade above or below its fair value. We've also seen similar situations in products like Tech, which is the Van Eck China A-shares product. Since you can't actually buy China A-shares, Van Eck has to negotiate swaps. Effectively, those costs get built into a premium here in the U.S., and that would be fine if it was consistent. However, if you look at that little circle I put on this, on one day last October, they had a $3 million redemption in the fund, and that drove what was a consistent premium in the fund straight into a discount. And that can hurt you if you're an investor. If you're the investor that bought at the top and sold at the bottom, that's a genuine problem you're going to face. So with that, I'd like to bring Luch in. Luch, you just heard me go on for a half hour here rambling about my thoughts about the emerging markets. I thought maybe you could step back and give us a little bit of a big picture about emerging markets. Give us a little context to start off with here.
Well, thanks, David, and I want to thank everyone for dialing in today. Let me just preface my remarks by acknowledging, the challenges that many of you face managing money in the current market environment, where the market seems to be trading off of movements in Spanish bond yields. This is an exceedingly difficult environment to be doing your jobs in. There seem to be so many exogenous factors that are impacting what's going on, and certainly these are, in some cases, eclipsing what's going on inside the emerging markets. We're going to be talking about Greek elections over the weekend, and in a week we'll be talking about QE3. In November, we're going to be focused on the election and whether or not we're going to avoid the fiscal cliff, and ultimately whether or not we get an orderly or a disorderly Greek exit from the euro. So a lot of that is going to impact what's going on in equity markets, and therefore it's going to impact what's going on in the emerging markets as well. But I think it's important in moments like this, even when risk is off, just to pause and just review some of the reasons why the case for emerging markets over the long term is still so appealing. In U.S. dollar terms today, the economies of the emerging and developing nations account for about 1/3 of the $65 trillion global economy. But they're accounting for about 2/3 of the global GDP growth. So at a time when most of the developed world is mired in very slow growth environments, 1% to 2%, in some cases in Europe right now, some of the countries are negative, you're still seeing economic growth in some of these places, even though they're slowing, but they're still growing. In China, 8%, in India, 5%, 6%, Mexico and Chile continue to grow 3% to 4%. So if you think about what that means, if you can average 3.5% global GDP growth over the next 20 years, the global economy would double from 65 trillion to 130 trillion. And overwhelmingly, the emerging economies are going to be driving that economic growth. Now, economic growth doesn't necessarily translate into great equity performance. The other piece of that equation is where you buy the equity markets. And we can talk about that in detail in a little bit. But the case for what's not going to change, I think, is fairly strong. I think you can say with some degree of certainty, looking at demographics, that most of the net additions that occur in terms of human beings on this planet in the next 20 years are going to come in emerging and developing world. Right now, about 85% of the 7 billion people in the world live in emerging and developing economies. In the next 20 years, that's projected to grow about 1 billion people. So when you have growing populations and you couple that with growing urbanization and younger workforces in many of these countries, you're putting together the ingredients that are going to give you tremendous demand for goods and services in these countries. And that's going to fuel construction and commercial and retail development. as well as consumer goods. As people's per capita incomes rise, you're likely to see greater consumption occurring in these economies. And you're also likely to see greater productivity growth, which is the other factor that's going to drive the GDP growth. As these nations become wealthier and have the ability to reinvest in their healthcare systems and education and infrastructure and R&D and the capital stock of their countries, they can improve their productive capacity, encourage innovation, and get greater productivity gains. Things like mobile phones make a big difference in terms of GDP growth, the internet, public entities, including sovereign countries, issuing debt so that they can build infrastructure projects. Corporations in these countries tapping global bond markets to finance their expansion is also a potential driver of productivity gains. So all of these things will be happening over the next 2 decades. And I think for people who are investing for the long term, they really need to be cognizant of where we are in the cycle when we get, moments where valuations are low relative to where they've been historically, and to invest opportunistically. And I think we're in that environment now because so much of what's happening is being driven by what's happening in Europe. And, as the euro declines, that has an impact on both the emerging currencies and people's appetite for risk assets. And so I think you're getting to the point of, interesting buying opportunities in some of these countries.
One thing that I've certainly heard a lot of, and we've actually we've already had quite a few questions come in. I encourage people to keep tossing those into the Q&A window. But one sort of concern that I hear is people hear that growth story, right? They read about the demographic shifts, they read about the population growth, but then they look to countries that they look to the bad examples. They look to countries that have experienced hyperinflation or huge unemployment spikes because of that population growth, and they see the political turmoil that's rolled through countries, whether it's whether we're looking at countries like Venezuela or even Greece right now. I mean, we're going to be talking about election. How can investors think about those political problems? And is this the one case where you actually want an active manager helping you stay away from those things? I've heard that argument a lot, that this is the realm of active managers, kind of like muni bonds, because you need somebody in there who's figuring out which one of these countries or which one of these companies is going to play by the rules and which one isn't.
Well, let's put the active to the side for a second. Let me address the first part of it, which is how do you deal with the risk? Well, I would say if you're a professional investor and you have expertise in this part of the world, you may want to think about how to allocate by country if you feel you have the expertise to do that. If you don't, probably the best thing to do is to get broadly diversified across the entire region. That means diversified, across 17, 18, 19 countries, so that you're not making any one bet that's outlandish on any one country. The narrower you get, the more risk you take on. If you were to try to invest in emerging markets because you wanted to play a sector theme, you're amplifying the risk that you're taking. If you want to try to get the return of the asset class, probably the best way to do it is to index, is to buy a exchange-traded fund that tracks a broad index that gives you the exposure. And a lot of people have been using, the 2 ETFs that are out there that track the MSCI Emerging Market Index. That's certainly the place to start when you're thinking about the beta exposure. Now, the downside of investing in a cap-weighted index is that it never rebalances back to any measure of relative value. So if you were to buy the cap-weighted market at the end of 2007, you're going to be buying China when it's trading at around 43 times earnings, when the dividend yield in China is about, 0.4%. That can set you up for very big drawdowns if the market goes down the next year, which it did. 2008, emerging markets went down 53%, and they were led down by the largest weight in the cap-weighted index, which was China, which went down about 63%. So that's the risk if you buy cap-weighted. And so I would say you probably want to look at an alternative that rebalances once a year back to where relative value is. And there, WisdomTree pioneered dividend weighting in emerging markets, and we think we have a very good strategy that does that. We re-weight the market back to where the dividends are being paid, both at the company level and at the country level, and we've had a lot of success doing that over the last 5 years. Certainly some active managers do a very good job at emerging markets, but it's always difficult to identify who they're going to be in advance. It's always hard to pick who are going to be the ones who outperform for the next 5 years. And just so everyone's clear, over the last 5 years, we have data that goes back to June of '07, the MSCI Emerging Market Index has beaten about 84% of all of the open-end active managed funds that are out there. So it's not necessarily an easy thing to do to beat an index over a long period of time.
Right. I had this on my list of questions I wanted to ask you, but we've already had it come from the audience too. We've had a couple questions about sort of specific narrow markets that people want to get at, but more to the point, markets people are trying to avoid. The South Korea problem, which I highlighted, is to some extent also somewhat the problem with China, it's also the problem with cap weighting, which is if you're going after sort of just what's biggest in that space, I understand your point about diversification, wanting to make sure you have a broad set of plays so that you don't get exposed to an Argentina at the wrong time or something like that. But by the same token, is there a place in the market for sort of funds that are kind of ex-brick, right? that are below that sort of top tier of nearly developed markets, where much of that growth may already be priced in, where the PEs may already be quite high, and instead favors the smaller tier? I mean, is that a kind of product that you think the market has room for?
Well, I think there's room for everything. I mean, in the ETF world, if there's a good idea, someone's going to try to equitize it. And there are people who invest country by country, and if that's their process, they have a way to evaluate where they think the relative value is, that's fine. The only point I'm trying to make is that when you're buying these equity markets, to have some sense of where valuations are to where they are historically. So for example, right now, MSCI Emerging Markets, the dividend yield is 3%, okay? There's only been 4 instances in the last 23 years where the dividend yield was higher than that in that cap-weighted index, okay? And the average return in emerging market equities for that index going back to 1987, the 1 year ahead return, the average return for that period was 17% in any calendar year. But if you bought into the market when the dividend yields were higher than they've been historically, the average return in the next 12 months was 34%. If you bought in when the dividend yields were below the median yield over that period, the 12-month returns in the year ahead were basically flat. So a lot of the return you get in an equity market is determined, believe it or not, by when you buy that market. And a big part of the return comes from the starting dividend yield. We actually have research at WisdomTree that shows you can take the starting dividend yield of an equity market, add to it the growth of aggregate dividends in that market, and then add or subtract the change of valuation in that market, and you'll get the total return for that market. And what's interesting is over the last 10 years, the annualized total return on emerging market equities is about 14.5%. What most people don't know is that the annualized growth in dividends over that time was about 14.5%. And so, having some sense for where markets are yielding is very, very important.
That brings up this whole issue of yield. I mean, the argument you're making, and I have read that research, right, and it serves really to point to dividend yield not so much as a source of cash flow, but as an indicator of value and potential value, which I think is an interesting approach. However, I've gotten a lot of questions in my email box over the years, particularly in the last 6 months, about people who are actually trying to yield invest. They're trying to get income streams out of their investment properties, and they're looking at a particular index that might have a dividend yield that's high, or a particular set of bonds that has an income stream that's high, or MLPs that have an income stream that's high. Is this an appropriate place for people who are essentially yield hunting for that reason, not because they're seeing it as a source of value indication? Is this an appropriate place to look, or should they be looking elsewhere?
Well, if we're talking about equities, I would say you need to keep your eye on both balls. There's 2 pitches that are coming, and you need to be able to hit both of them. One of them is the dividend yield, and the other one is the growth of dividends. So, there's definitely a risk if you're hunting for yield and you're doing it with 4 or 5 stocks. So the smaller your portfolio, the more risk there is that you might get caught in a value trap or that the dividend is not sustainable. The broader your portfolio, so if you're owning an emerging market portfolio with 300 or 400 companies, you're not taking on really that great individual stock risk. You're diversified. And you have a much greater chance of capturing the aggregate growth in dividends over the entire region, just in case one company can't grow and has to cut. So again, they're both very important for your total return, and certainly on the equity side, I would say you want to maximize your dividend income to the maximum extent possible. Because in the S&P, historically, if it returns 10% a year, historically about 4 percentage points of that came from the dividend yield. If you're in a low growth environment where you think equity returns from this point forward are going to be 5, 6, 7% if you're lucky, you want to maximize the dividend yield on the front end of it. And rather than buy equities in America and get paid 2% for owning them cap weighted, it may make sense to buy them dividend weighted and start out with a starting dividend yield of 3%.
And how much of any of this is impacted by the currencies thing? I mean, I made a big deal about it in my presentation. Do you think that investors should be considering hedged products versus non-hedged products? I mean, I've had some people say, the reason I don't invest internationally is because I don't trust other people's banks, not because they don't trust other people's stocks.
Well, it's certainly a legitimate point. I mean, if you think about where the risk in the world is today, it's at the sovereign debt level, and then it's related to what's going on in the banks. So that's certainly an understandable point. I would just say, though, if for the people who make the argument you can get broad emerging market exposure just by buying U.S. multinationals, you need to remember that if you did that strategy over the last 10 years, you likely would have underperformed the emerging market equity market by about 10 percentage points per year because you didn't actually own the individual companies. If you don't own the emerging market companies, you don't get the benefit of their dividend growth. They've been able to grow their aggregate dividend stream much faster than we've been able to grow in the United States. And you also miss the benefit of the currency appreciation over time. Now, I understand some people make the argument that currencies net will net out and there won't really be a meaningful impact over a long holding period. But in the emerging world, you may have 10 or 20 years ahead of you where these countries move from export-led economies to more consumption-led economies, where they actually have an incentive to let their currencies appreciate. China's a good example. And if you believe you want to be tilted towards where the countries have surpluses, where they have low debt-to-GDP ratios, where they have faster-growing economies, and in some cases where they have positive real yields, which is very hard to find in the world today, overwhelmingly that leads you to emerging market economies, particularly the Asian economies. And so I think a lot of people make the case that you actually want to get exposure to the emerging economies for the long term because it may add 1 or 2 percentage points annualized to your total return.
What's the angle there for inflation? We had a good question from the audience pointing out that Richard Bernstein recently wrote that investors should be more concerned about inflation in emerging markets than they should be in the U.S. If you're allocating, I guess particularly to emerging market bonds, which I think are the most sensitive to the currency fluctuation, do you need to be worried about inflation in Brazil?
Well, certainly. You need to be worried about inflation anywhere if you're a bond investor. And so I would say that, obviously in emerging markets, there's 3 big risks on the fixed income side. One of them is certainly inflation. The other one is the default risk if you're dealing with a sovereign issuer, certainly. And liquidity risk. How deep is that market of bonds you're working with? So I would say there, you certainly want to keep an eye on it, and there are, countries that are a little bit more vigilant in terms of managing their inflation expectations. And, if you do feel that you're not comfortable taking the currency risk, there are ETFs out there where you can buy where the bonds are actually denominated in dollars. Emerging market corporate debt is a good example where the market is developed. There's about $450 billion of corporate debt outstanding, and it's predominantly in U.S. dollars. So there you're not taking on the currency risk of the country. You're just taking on the creditor risk of those companies. But that credit profile is very appealing. I mean, it's not like you're getting a high yield exotic portfolio. It's overwhelmingly investment grade, and many of these same companies you already own on the emerging market equity side. So it's actually a chance to go up the capital structure and take advantage of some higher yields that are available outside the United States.
You know, the bond thing is interesting. I mean, we've done a lot of research on the pros and cons of bond rating and the different approaches that bond rating agencies take. You know, one question that we've had that I'm not sure I have a great answer to is, you know, can you trust, you know, S&P's rating of either sovereign debt or corporate debt outside the U.S.? The same way you can trust it in the U.S. to the extent you can even trust it in the U.S. Or in other words, if you're looking at, you know, I put up there that broad sovereign market, sovereign emerging portfolio was a BB minus. Can you really trust that? Can you make a legitimate comparison between, say, that BB minus and the BB minus on a particular pool of U.S. debt?
Well, S&P calculates our indexes, so I'm not going to say anything negative about S&P. But I'm going to just speak generally about credit ratings. Certainly, I mean, you know, when S&P downgraded the U.S. debt, the treasuries rallied right afterwards in kind of a perverse way. So I think the market has its own way of discounting where the risk is in the world. And I would say certainly when you go outside the United States, I think this is where there's actually a very strong case to be made for using an active manager on the fixed income side, because I think that's really where some of the best fixed income managers can add value, doing the analysis, particularly at the company level, of the credits and doing their own research about who has a business that's, you know, generating enough cash to cover their obligations. This is one of the reasons we actually used an institutional asset manager, Western Asset Management, to serve as the sub-advisor on our emerging market corporate bond fund, so that they do have the ability to do that due diligence at the company level. And so I certainly think there's a role for active management on the fixed income side internationally.
You know, I've gotten a sense, you know, Lucius, from the last few minutes and sort of certainly from your introductory remarks that you don't seem to be a big fan of sort of a narrower, more country by country or sector by sector approach to things. You know, you seem fairly cautious there, and that's great. But you know, I look at sort of the list of countries out there, and I think about the South Korea problem. I think about the sector weighting problem. I mean, do you think that you know there's room here for a sophisticated advisor, a sophisticated investor, to make a better play than just buying the broad market or buying an alternative index? I mean, is it a mug's game to sit there and sort of try to reconstruct your own index that doesn't have, say, China and South Korea and India in it because you feel like that those are played out?
No, I think there's a role for the country investing, and I know some advisors do it. The only point I'm making is it requires a certain amount of expertise and a certain discipline, a certain process. So if you don't think you have access to that data to do it in a way that you think you can handle all the uncertainty that's out there, you're probably better off getting broadly diversified. And you know, if you're, you know, certainly if you're, you know, less experienced running a country model. I mean, there's been a lot of examples where folks have a great theme and they want to invest in it, and then when the ETF comes out, it doesn't always do that well because it's too narrow, it's too concentrated, and the fund gets launched after you know, the investment theme has already been capitalized on.
Sure.
I mean, there are examples where, you know, I know that you know, if you want to play the infrastructure trade in India and you try to get it through a fund, in some cases you would have been better off just owning India, broadly diversified. Now, Brazil, you might have a different conclusion, but you know, the point I was just trying to make is the narrower you get, the less likely you are to get the return of the whole asset class. And if you're trying to beat the asset class, you know, you're taking on a certain amount of active risk that even the best active managers have a hard time overcoming.
you have any thoughts on the correlation stuff that I was putting up before, the sort of that shifting sands of correlation where, during volatile periods we saw the broad asset class of emerging markets get just really super correlated to virtually everything from gold to the S&P to treasuries. And then things sort of settle out and they become, as volatility decreases, we see those correlations come down. That implies, I think, to some investors that there's a timing opportunity here. And then I put that in, I put a pin in that, and then I listened to your comments about, if you were picking the high reported yield times as an investor and skipping the low reported yield times, you would have been better off. I mean, that sounds an awful lot, putting those together, it sounds like an argument for market timing.
Well, I think it's an argument for having some sense of where valuations are. Just like you wouldn't want to buy Japan in 1989 at the top of the bubble, there are moments where you want to be buying markets because they're trading at the low end, of where they've traded historically. With respect to correlation, I think there's two things going on. One is the economy, the global economy is much more globalized. So when you have these large multinational corporations in the emerging markets, companies like Petrobras or Samsung, they're going to move with the global macro events. So that's one of the reasons you're seeing higher correlation. The other reason, I think, is because of what happened with the dollar and the euro over the last 3 years. I mean, there was a period there where the dollar and the euro were almost inversely correlated. And when the dollar, went up in value, the U.S. equity market went down in value. Emerging markets went down. Emerging currencies went down. The euro is a very important barometer for global GDP growth. If the euro is weakening, it's saying something about European economies, and that has an impact on what those economies can import from the emerging world, particularly from Asia. And so you get this sell-off in emerging market currencies, which you see then in the emerging market equity returns, and the perception is, well, these economies and these currencies are weakening. They are weakening, but sometimes they're not weakening for anything fundamental in their own country. They're weakening because there's something happening in Europe, and a lot of people are taking their trigger today from the euro and from Spanish bond yields. So all I would say is, if nothing changes in the emerging world in the sense that they still can grow at 4, 5, 6, 7 percentage points a year, and they can still keep their debt to GDP ratios in that kind of 30 to 40% range, and they still have attractive demographics and investment and surpluses, if nothing's changing fundamentally, I think you want to take advantage of when you have these sell-offs in the currencies and the equities. To load up for the decade ahead.
So we've had a number of country-specific questions, and I think I could sort of roll them all up into one of my own that I think captures it, which is, with so much focus on emerging markets, right? We saw the chart. I had something like 148 emerging markets equities funds, which I find frankly staggering, right? I mean, 10% of all the ETFs in the market cover emerging market equities. I guess the question is how much of this is priced in, and how much of this is sustainable as more investment money piles in, and should investors instead be thinking about, and I hate to even use the term frontier markets because talk about people not being able to agree on a definition of something. But there are products out there, there are indexes out there that track, Egypt and Peru and Lebanon and Nigeria and countries that actually fall off the bottom of the MSCI emerging markets list. How far is too far to go in pursuit of that?
Well, certainly you want to make sure there's enough of investment capacity if you're investing in size. I would just think of it in terms of proportion. I mean, right now, emerging markets is about 10% of the global market capitalization, but it's about 16% of the total dividends that are being paid around the world. So frontier markets are going to rank much lower than that. I would just say that frontier markets, they typically don't become a hot theme until after emerging markets have already had a very large run. And with emerging markets down last year and basically flat this year, I certainly would not be hurrying into frontier themes when there's a lot of bread and butter emerging market exposure that's right in front of you, that a lot of people, for whatever reason, have not been taking advantage of the last quarter as they've plowed into U.S. short-term fixed income.
Right. Well, that brings us to the end of our hour here. Luch, any closing comments before we wrap it up? This has been super interesting. I know I've been enjoying it.
I would just invite everyone to come to WisdomTree.com if they'd like more information on what we do. There's standardized performance for all the funds that were discussed today, as well as prospectuses that disclose all the risks and fees associated with our funds.
Super. And, you know, I'd also just point out that this will be available and the slides will be available on our website within a few days, IndexUniverse.com. You can also use our ETF finder there to help dig through these hundreds of emerging market opportunities you have. If you'd like to learn more about our ETF analytics process, our next webinar on June 22nd, we'll be going through not just how we approach emerging markets and international, but all ETFs. Thank you for joining us. We'll see you soon.